Yes, my fellow countrymen. Today, I'd like to address a crucial aspect of our Kenya's economic landscape: the implementing or the impending maturity of the Kenyan bond due in June of this year, 2024, and the significance of refinancing and raising dollars so that we can fund our foreign exchange and, of course, our liquidity. The maturity of the Kenyan bond represents a pivotal moment of our national financial stability. It's a reminder that our responsibility to manage our debt obligations prudently and carefully while ensuring the continued smooth functioning of our economy. Refinancing this bond offers us an opportunity to renegotiate terms that may be more favorable to us, such as securing a lower interest rate or extending the repayment period. This strategic move not only eases the immediate burden on the debt repayment, but also provides flexibility and breathing room for our government to allocate resources towards other critical areas of development. So, furthermore, raising dollars funding for foreign exchange, liquidity, and other monetary gains addresses a fundamental aspect of our economy. Of course, maintaining adequate reserves for foreign exchange and foreign currency and reserves are essential for stabilizing our currency. And of course, this facilitating international trade and ensuring liquidity in our financial system. By this, we are bolstering our reserves through fundraising in dollars. We can enhance our ability to withstand external economic shocks, manage balance of repayments, and foster confidence among investors and international partners. Now, this implication of these actions extend beyond our borders. As Kenya strives to secure its financial footing, we must also consider the broader regional context. Recent developments in East Africa, as Tanzania's ambitions to become a fuel hub and Uganda's potential shift of port activities to Salam, these underscore the need for Kenya to adapt and respond strategically to changing dynamics in the region. By refinancing our debt and fortifying our foreign exchange reserves, we position ourselves to navigate through these challenges with resilience and agility. Now, the refinancing of the Kenyan bond and the raising of the dollar funding for foreign exchange liquidity are merely financial transactions. They are critical steps towards ensuring our nation's economic stability and, of course, the nation's resilience. As we embark on this journey, let us remain steadfast in our commitment to prudent financial management, strategic foresights, and the collective prosperity of our beloved country. So, this idea of the development of which now the shaping the energy and infrastructure landscape on East Africa, where recently 2 Chinese companies have been awarded contracts to construct tanks associated with infrastructure for the receiving, the storage and distribution of petroleum and energy at the port of Salam in Tanzania. Concurrently, the China Railway has secured this deal with Tanzania to build a fuel depot, underscoring Tanzania's ambition to position itself as a fuel hub of East Africa. So these developments mark a crucial turning point in the regional energy dynamics. Of course, with Tanzania now emerging as a key player in meeting the energy needs of the entire East Africa region. And of course, this comes at a time when Uganda explores the possibility of moving its port activities from Mombasa to Dar es Salaam. Now, Tanzania's strategic investments in energy infrastructure has become even more significant. The ongoing negotiations between Uganda's Ministry of Energy and Tanzania to facilitate importation of all oil products via the port of Dar es Salaam. This just further solidifies Tanzanian position as a preferred gateway for oil in the region. It's crucial to recognize that these developments may pose real challenges to Kenya's existing investment in energy infrastructure. As you well know, Kenya just invested $385 million in the Kipevu oil terminal in Mombasa and a further $170 million in the fuel jetty in Kisume. And both these, Kipevu and Kisume, may face threats of Tanzanian plans of becoming an oil hub in East Africa. These threats, if Tanzania plans come to fruition, it will be difficult for the investment that Kenya has made. Moreover, Kenya's loss of $200 million worth of exports to Uganda in the last year has been crucial. As you well know, Uganda is Kenya's largest regional partner. And since October 2023, which is just barely 6 months ago, Kenya has lost over $200 million worth of exports to Uganda. So in light of these developments, Kenya's decision to refinance the bonds, to raise dollar funding, and of course for foreign exchange and liquidity, this becomes even more important. As Kenya navigates through these economic challenges, it's imperative for the country to assess its strategic priorities and explore opportunities for collaboration and cooperation with its neighbors. As we move forward, it's essential for East African nations to work together to harness the region's collective potential and foster sustainable growth and development. By promoting collaboration, transparency, and inclusivity, we can overcome the challenges and seize opportunities to create a brighter future for all. It would not make any sense for both Kenya and Tanzania to have all these huge petroleum or oil ports in one region. As you can see, Kenya has already invested almost $385 million plus another $170 million. And now Tanzania is getting into a deal with China. These are both ports in East Africa that the hinterland, which is Uganda, Rwanda, Burundi, South Sudan, needs these ports. I don't know, somebody might serve me a better reason or a better answer why we need two such ports in the coast of East Africa. And barely these ports are barely 200 miles apart. Again, collaboration, communication, and transparency are key towards development of these East African countries. Thank you.